Hello there. The final part of Lecture Series 12 on IAS 37, Provisions, Contingent Liabilities and Contingent Assets, will focus on the application of the recognition and measurement rules in specific situations. Let's start with future operating losses. Provision shall not be recognized for future operating losses, as it does not meet the general recognition criteria set out for provisions, as it relates to future events and not past events. Please note, however, an expectation of future operating losses is an indication that certain assets of the operation may be impaired, and these assets shall be tested for impairment under IAS 36, Impairment of Assets. Next, if an entity has a contract that is onerous, meaning the unavoidable cost of meeting the obligation under the contract exceeds the economic benefits expected to be received, the full loss should be provided for as a liability. The provision amount recognized should be the lower of cost of fulfilling the contract and any compensation or penalties arising from failure to fulfill the contract. Restructuring costs associated with reorganizing a business as a result of, for example, sale or termination of a line of business, closure of business locations in a country or region, or relocation of business activities to another country or region, poses two issues, that is, 1. Whether an obligation exists at the reporting date, and 2. The cost that should be included within the provision. A provision for restructuring is only recognized when the general recognition criteria of IAS 37 is met. This was covered in Part 1 of the lecture series. For restructuring, a constructive obligation arises only when the entity has 1. A detailed formal plan, and 2. Has raised a valid expectation to those affected that it will carry out the restructuring by starting to implement the plan or announcing the main features of the plan to those affected. A restructuring provision should only include direct expenditure arising from restructuring. As such, IAS 37 specifically excludes retraining and relocating costs, marketing, or investment in new systems and distribution network costs as they relate to future conduct of the business and are not liabilities for restructuring. Finally, let's look at decommissioning cost. An entity may have an obligation to dismantle, remove, and restore a site at the end of the useful life of an item or PPE. As such obligation exists on initial expenditure on construction of the item or PPE, IAS 37 requires the liability to be recognized immediately. This is consistent with IAS 16, Property, Plant and Equipment, which stipulates the initial estimate of the cost of dismantling and removing the item and restoring the site at the end of the item's useful life should be included in the cost of the PPE on initial recognition. Thus, to the extent a provision is recognized, the initial estimate of the foreseeable expenditure discounted to its present value is capitalized as part of the PPE's cost on initial recognition. The measurement principles of IAS 16 was covered in Lecture Series 3. With this, we have come to the end of Lecture Series 12 on IAS 37, Provisions, Contingent Liabilities and Contingent Assets, covering the following areas: definition and recognition criteria of provision, contingent assets and liabilities, reimbursement, and finally applications of recognition and measurement rules to specific situations. The next bite-sized corporate reporting lecture series will focus on IFRS 5, non-current assets held for sale and discontinued operations. Till the next lecture series, thank you and have a pleasant day.